Last year, regulators issued over 84,000 notices designed to do basically one thing.
Just one thing.
Right. To pierce the corporate shield and legally seize the personal homes and savings of company directors. So welcome to the deep dive.
Yeah, thanks for having me. It's an intense topic today.
It really is. Today we're looking at the actual realities of corporate law in 2026. And we're pulling from this really fascinating brief by Trinity Accounting Practice. It's called Piercing the Veil, the 2026 Director Liability Survival Guide.
Great title, very fitting.
Yeah, seriously. Because the whole premise of setting up a private limited company, a Plighty Ltd., it's always rested on limited liability.
Right, that's the whole point of doing it.
Exactly. The idea that if the business fails, the fallout stays contained within the business. Your house, your personal bank accounts, your retirement savings, they all remain untouched.
Well, theoretically untouched.
Right, theoretically.
Yeah.
Because this source material paints a very, very different picture of what's actually happening right now.
Yeah, I mean, we are looking at a landscape where the Australian Taxation Office, the ATO, and the corporate regulator, ASIC, have completely abandoned their pandemic-era leniency.
Which makes sense, but it's jarring.
It is, because for a few years, they took this really soft-touch approach, since the entire global economy was under unprecedented stress.
Right, we all remember that. They were just issuing warnings.
Exactly. Warnings, letting massive debts accrue. And they rarely, if ever, pursued individual directors. But that grace period is definitively over.
Done.
Yeah, completely done. The regulators have shifted from sending polite reminder letters to aggressively dismantling the barriers that separate corporate debt from personal wealth.
Okay, let's unpack this. Because whether you run a multi-million-dollar enterprise or sit on the board of a small local startup or, you're just someone who loves understanding the hidden mechanics of our financial systems, this changes everything about how we understand personal liability.
It really does. It flips it on its head.
So the Survival Guide outlines two massive vulnerabilities regulators are exploiting right now to reach straight through that corporate shield. And the first step for any regulator, obviously, is knowing who to target.
Right, because a company is just a legal fiction.
Exactly.
Yeah.
So the government has to pin that fiction to a real, breathing human being. Which brings us to the director identification number.
Yeah, the director ID. This is the foundational tracking mechanism for regulators now.
So how does it actually work in practice?
Well, it's a permanent, unique 15-digit number issued through the government's registry services, and it attaches to you as an individual for life.
For life. Like, no matter what.
No matter what. I mean, you could resign from a board tomorrow, take 5 years off, go live on a beach, and then start 3 new companies a decade from now. You'll use that exact same verified identity.
Wow. And they implemented this mainly to kill what they call Phoenix activity, right?
Yes, exactly. Phoenix activity is, it's that practice where directors intentionally rack up massive supplier and tax debts, and then they just liquidate the company to dodge paying them.
Oh, and then they seamlessly transfer the assets to a brand new identical company.
Right. Rising from the ashes just like a phoenix.
Hence the name. But the guide makes it clear that the tracking device itself isn't the actual threat here.
No, not at all. It's just a number.
The threat is how the enforcement of this 15-digit number has drastically evolved. Because initially, the rollout was treated as an administrative courtesy almost.
Yeah, like a soft obligation.
Right. But now, failing to hold a valid director ID when required is classified as a strict liability offense. And I actually have to push back here a little bit.
Yes, go ahead.
Because holding someone strictly liable sounds incredibly unfair if they're running a massive enterprise. I mean, how can a board member of a 500-person company be expected to face severe personal penalties just because, say, a mid-level compliance officer missed a registration deadline?
Well, it might sound unfair, but the courts view it through a very, very narrow, unforgiving lens.
Really? No exceptions?
No exceptions. Strict liability means intentions, administrative bottlenecks, or, relying on negligent staff. It's all completely irrelevant.
Wow.
The court basically asks a binary question. Were you legally required to hold a verified director ID, and did you have one?
Yes or no?
Exactly. If the answer is no, the liability falls squarely on you. So saying, I assume my accountant handled it, That holds the exact same legal weight as saying, I willfully ignored the law to commit fraud.
So I assumed my accountant handled it is legally identical to I willfully ignored this.
Yeah.
That is terrifying.
Yeah, the legal system is intentionally forcing ultimate accountability right to the absolute top of the chain.
And the financial consequences of missing that binary check are severe. Like the maximum penalty for simply failing to have this number is nearing $20,000.
Yeah, and ASIC is actively taking directors to court to make this point.
They really are. The guide details this recent Sydney case where 2 directors were dragged into the local court and they were fined $10,000 each.
Yeah, and ASIC stated publicly that those penalties were designed to send a signal to the broader director community.
A warning shot.
Exactly. They are actively hunting for people to make examples out of.
But the irony here is kind of wild.
Oh, the asymmetry of the risk versus the solution?
Yeah. The fine is potentially devastating, 20 grand, but resolving the vulnerability is completely free, and it takes, what, roughly 10 minutes?
Basically 10 minutes using the government's digital identity app, MyGovid.
Right. But the catch is that directors cannot delegate this task.
No, they can't.
Yeah.
Because the system links biometric data and personal identity documents, passports, driver's licenses, directly to the corporate registry.
So the director must personally execute the registration. You can't just pay a high-end corporate lawyer to make the problem go away.
Nope. You have to sit there with your phone and do it yourself.
Which is funny, considering the stakes. But knowing who you are is completely useless to the ATO unless they have a legal mechanism to actually take your money.
Oh, yeah, and they definitely have one.
Right, and that's where the second, much larger financial threat comes in, the Director Penalty Notice, or DPN.
Yeah, the DPN.
If the Director ID is the map that locates your personal assets, the DPN is the weapon they use to seize them.
That is a perfect way to put it. The DPN is a very specific legal carve-out.
How so?
Well, as a general rule, a private company's debt to a supplier is its own problem, right? The corporate veil protects you. But the law allows the ATO to pierce that veil for 3 distinct categories of debt.
Okay, let's list those.
First is PAYG withholding, which is the income tax withheld from employees' paychecks.
Got it.
Second is the superannuation guarantee charge, so unpaid employee retirement contributions. And third is GST.
So if a company falls behind on those 3 things, what happens?
The ATO can issue a notice that legally transfers those specific corporate debts straight onto the individual director.
Man. And the data in the Trinity accounting guide on this is just staggering. In the 2024-25 financial year, the ATO issued over 84,000 of these director penalty notices.
84,000 is a huge number.
It's a 136% jump from the previous year. We are talking about an industrial-scale debt recovery operation here.
Yeah, and if we connect this to the bigger picture, the ATO's ruthless focus on these 3 specific taxes makes perfect sense.
Because it's not just regular business debt.
Right. PAYG and superannuation are not normal business expenses. That is employee money.
It's the workers' money.
Exactly. The company was simply holding it in trust to pass on to the government or the super fund. So when a company uses that money to prop up cash flow or pay other suppliers, the law basically views it as theft of employee entitlements.
Wow, theft. That's a strong word, but I guess legally that's the angle.
It is. The legal system will always prioritize the protection of workers' wages over a director's right to limited liability.
Wait, let's talk about the timeline here because this is where it gets really stressful. The guide says once a DPN is issued, a director has exactly 21 days before their personal savings and home are on the hook.
Yes, a 21-day window.
It's like a ticking time bomb. 21 days. I mean, in the corporate world, it takes 3 weeks just to align schedules for a simple board meeting.
Oh, I know.
How is a director supposed to find an administrator, process all the paperwork, and execute a complex restructuring or liquidation in that tiny time frame?
Well, the reality is chaotic, right? And the friction involved is immense.
I can only imagine.
And here's the worst part. The 21-day clock starts ticking the moment the ATO posts the letter, not when the director actually opens it.
Oh, you're joking.
I wish I was. So if it sits in a mailbox over a long weekend or you're out of town, you're already down to like 17 days before you even know about it.
That is brutal.
It gets worse. Then the director has to find a registered insolvency practitioner willing to take the job. And administrators don't work for free, and they know the company is broke.
All right, so how do they get paid?
They demand a massive cash retainer up front, often tens of thousands of dollars, or personal indemnities from the director before they even sign the paperwork.
So the director is essentially scrambling to liquidate personal assets, or drain their own private savings just to hire the person who can legally step in before the 21-day timer hits zero.
Exactly. The pressure is absolutely crushing. The director is frantically gathering financial records, negotiating with insolvency firms, and dealing with the psychological realization that their entire business is collapsing.
All while a literal countdown threatens their family home.
Yeah, it's a brutal environment. But taking those drastic steps within the 21 days is the only way to sever the personal liability for the debt.
Okay, this brings us to what I think is the most surprising part of the entire survival guide.
The lodgements.
Yes, because surviving a massive tax penalty doesn't come down to brilliant legal maneuvering or setting up offshore accounts. It comes down to a seemingly boring administrative habit, routine tax lodgements.
Yeah, just doing the paperwork.
Right. So the guide breaks down two different types of director penalty notices. And which one you get basically dictates whether you have a lifeline or if you are doomed to personal bankruptcy. So let's look at the first one, the non-lockdown DPN.
Right. So a non-lockdown DPN occurs when a company's cash flow is non-existent, like they literally cannot pay the tax bill, but they still fulfilled their legal reporting duties.
Meaning they did the paperwork.
Exactly. They submitted their business activity statements, their BAS, on time. They submitted their superannuation reporting on time. They effectively raised their hand and told the ATO, hey, we calculate that we owe you this much money, but the bank account is empty.
And because they reported it, the law leaves an escape route open.
Yes.
So the non-lockdown DPN gives the director that grueling 21-day window we just talked about.
Okay.
I mean, the business might be dead, they might have to hire an administrator and hand over the keys to the company, but their personal home remains safe.
Right. The corporate shield holds, barely, but it holds.
But the alternative is the lockdown DPN. And this is the nightmare scenario.
It really is. This is the scenario where the company not only failed to pay the debt, but the directors panicked and failed to lodge the reporting paperwork within the required timeframes.
The business just went entirely silent.
Exactly. Radio silence.
Here's where it gets really interesting, because the guide is brutally clear on the consequence of going silent. With a lockdown DPN, that 21-day escape route does not exist.
Vanishes.
Putting the company into voluntary administration will not save you. Liquidating the company will not save you. The moment the ATO issues a lockdown DPN, that debt becomes permanently and inescapably yours.
Yep. The debt instantly bypasses the corporate structure and attaches directly to the director.
Wow. So what can the ATO do then?
Well, then they can utilize all of their debt collection powers against the individual, garnishing personal wages, freezing personal bank accounts, and yes, forcing the sale of private property.
So the distinguishing factor between keeping your house and losing it is not whether the company was profitable.
Not at all.
It is purely whether the company lodged its routine administrative paperwork by the due date.
Purely that. Yes.
It's like dealing with the fire department. If you pull the fire alarm, which is lodging your paperwork, when the flames start, even if you don't have a hose to put the fire out yourself, the authorities give you a chance to step out of the burning building.
Right, because you did the right thing by alerting them. You didn't hide it.
Exactly.
Right.
But if you hide, don't lodge, and basically wait for the house to burn down, the ATO locks the doors and you foot the entire bill.
And, if you stay in that burning building, the law assumes you're choosing to take on the financial heat.
Yeah.
Because when a struggling business owner gets scared, the psychological instinct is to hide.
Oh, 100%. It's human nature.
Right. They think that submitting a tax return showing a massive debt they can't pay will immediately trigger an ATO audit or aggressive collection action.
So they just put their head in the sand.
Exactly. They stop lodging altogether.
They think silence buys them time to turn the business around and find the cash.
Precisely. But legally, that silence is fatal. Failing to lodge strips away the only defense a director actually has.
It's crazy.
So the overriding lesson from all this 2026 enforcement data is that a struggling business must preserve its options. Lodge on time, every single time, even if paying the bill is a mathematical impossibility.
Because the paperwork is what keeps the personal liability door shut.
Yes, exactly.
So what does this all mean? I mean, the concept of the impenetrable corporate shield is basically a comforting illusion at this point.
Pretty much.
The corporate wall has a very specific door in it. The strict liability of the director ID ensures that regulators know exactly who is standing on the other side of that door.
Yep. They have your 15-digit number.
Right. And the director penalty notice is the master key they use to unlock that door and walk straight into your personal finances when employee taxes and super aren't paid.
And, this actually raises a really important question about who is standing behind that door, because we need to address what the guide calls the silent partner trap.
Oh, yeah, the silent partners.
Because this exposure does not just apply to the active, day-to-day CEO who is sitting there making the financial decisions.
It applies to everyone, doesn't it?
It applies indiscriminately to everyone listed on the corporate register.
Which is terrifying because the guide specifically warns about, say, spouses who are added as directors purely for tax distribution purposes.
Oh, it happens all the time.
Or investors who take a board seat but never actually look at a balance sheet.
Yeah, the law simply does not recognize the concept of a silent director. If your name is on the registry, you carry the exact same personal exposure as the managing director.
Oh, wow.
You are equally liable for the strict penalties of the director ID regime, and you are equally in the crosshairs of a lockdown DPN if the company's accountant just stops lodging the paperwork.
So treating directorship casually or, as an honorary title in 2026 is a recipe for disaster.
It is exceptionally dangerous.
It really reframes the entire concept of starting and running a company. You'd think protecting your personal livelihood requires a team of specialized lawyers, but it literally comes down to verifying your identity on a government app and ensuring routine forms are submitted before a deadline.
It's the boring stuff that gets you.
It really is. Well, thank you for joining us on this deep dive, and we'll leave you with a final thought to mull over. If regulators can completely pierce the corporate veil and seize your family home over something as mundane as late paperwork for superannuation and PAYG, what other boring administrative tasks hidden deep within the business world might secretly hold the power to dismantle a person's entire financial life? Just how secure is the rest of that corporate fortress we all take for granted?